Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, July the 11th, and want to take just a brief minute to discuss what markets did last week as the S&P 500 continued to be the only game in town playing, with it up 1.95% on the week. So the S&P 500 was positive 1.95% last week. The mid-cap index was down 1.17% on the week, and the small caps were not down quite as much, but we're down 1.10% on the week. And just wanted to talk a little bit year to date. The S&P, as we're talking right now, is up over 17% year to date. However, the equal weighted index is only up 5% year to date, a little over 5%, 5.4% to be exact. So you have 12 percentage points of gap there between the two indexes. So if your portfolio is not keeping up with the S&P 500, I wanted to give you some reprieve as the average stock is only up 5% year to date. The index is up 17%. And the index itself has been very narrow, being led higher by just a handful of technology names and a couple of healthcare names that are associated with GLP-1s, or the weight loss shots or drugs that are taking the U.S. by storm. But as we got today's inflation report, we got month over month inflation of a negative 0.1% when we were expecting up 0.1%. The inflation rate continues to fall. You had the Fed chairman speaking in front of the Senate and the House this week, stating that he believes that the next move for the Federal Reserve is actually going to be to cut, not to raise. So he really started to change his tenor at these hearings this week, giving the market some pause, or giving the market some expectation that the next thing coming is a cut, which has allowed the market to actually broaden out a little bit. So if you look at the headline today and you looked at the S&P 500 to say, why is it down today off of the great inflation report? Well, the equal weight is actually up over 1% right now as we're speaking at 2:24 p.m. on the 11th. It is up over 1% while the S&P is down around 80 basis points. This is because this is what we've talked about. You're going to see at some point a rotation out of what's been working, the only game in town that's been working, into the average stock. So you're going to see these large cap, mega cap stocks get sold off to buy the cyclical sectors of the index. And you're seeing that happen today, where the breadth and the volume actually looks good, but on the surface it doesn't look like a great day in the index. And that is because the index itself is so heavily weighted towards these large cap names. So with the good inflation report, with the hearing this week, when do we expect the Fed to actually cut rates? And why should they do it when we expect them to? Well, we really at River Place, we would love to see the Fed cut rates in July at this Fed meeting that they're going to have this month, because we are starting to see anecdotal signs of slowing. Retail sales was negative, and for the month of May, we haven't gotten June's retail sales yet. And so we're still waiting to get that. The consumer is slowing and pulling back. And what is the challenge for the Fed is they want to see some slowing. You're seeing the unemployment rate tick up. It's up above 4% now. It's been below 4 for a long time. And as inflation gets closer to the 2% target, it gives cover for the Fed to start cutting rates. And what we would like to see is them cut sooner rather than later, while we're getting just the beginnings of the slowdown, to see the cuts happen now. Because monetary policy, just like with raising rates, when it comes to cutting rates, comes with a lag as well. And what you don't want to see is cut rates when the time you get all the data and the data showing, oh my gosh, we're in a really big slowdown. That's too late to navigate the soft landing. Realistically, though, we anticipate the Fed cutting rates, potentially doing their first rate cut in September. We would love to see it in July, but really don't foresee that happening until the September meeting, where they're going to say we need a little bit more data. Even though we've had 4 months of inflation coming down, they're still going to use that as cover to not cut rates. They don't want to also seem like they're playing politics and all. I understand that, but ultimately the economy is more important than an election cycle. So we look forward to September to see the rate cut, and that's why you started to see the broadening out of the overall equity markets. And we anticipate that being the potential case when the rate cuts happen. But we want to make sure that the economy holds up until then. So if you have questions about how to navigate this time or what you see the Fed doing or where markets are going to go from here, we expect to see some volatility this quarter until we get that first rate cut. So just give us a call. We'd love the opportunity to walk you through that, how to manage that, and talk you through that. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.